information, it will be recorded. Sorry, go for it.
Awesome. So just to touch base, and try and get a handle on the ever-changing credit landscape, like Pinky had mentioned, the mortgage industry is as fluid as it's ever been, and it changes on a daily basis. And unfortunately, we've now seen that in the credit reporting industry. So it's already tough enough when you consider the fact that the average person doesn't realize that there are about 40 different FICO scores that are floating around out there. And as agents, the trouble becomes if you're looking at a credit report from Credit Karma or Credit Sesame, unfortunately, those reports are not worth the screen or the paper that they're printed on. So with all of that in place, and now looking at FICO has rolled out a couple of new FICO scores. So the FICO scoring model, when you talk about a monopoly, if you sit back and think about it, it's the only game in town. And the FICO scoring model has been around since the 80s. It's used in about 90% of underwriting in the world for all banking, for all credit transactions, and insurance. And the problem is that scoring model and the entire credit reporting industry is flawed at best. So each year, one of the top 3 complaints to the FTC has to deal, is always regarding credit. The credit bureau's erroneous information on credit reports. The FTC and the CFPB have tried to put a number on the amount of errors on the credit reports out there. There are about 230 million credit profiles with the big 3 repositories, TransUnion, Equifax, and Experian. And the FTC and the CFPB have come out and said that they think about 25% of those reports contain false, inaccurate, unverifiable, outdated information. I will tell you, after doing this for about 16 years now, for the clients that come through our program, we see that number at about 90%. 90% of the credit reports that we look at have information on there that does not belong there. And it's that very information that oftentimes causes a lower credit score. So when you're talking about that and how it impacts the real estate professional, I firmly believe that credit is the cornerstone of real estate. It's either going to cost or save the borrower, the consumer, money each and every day of their lives. When you talk about interest rates and also insurance premiums, I think everybody now does realize that your credit scores, they're not called credit scores when it's used for underwriting insurance. They're called insurance scores. It's the same information. It's the same score. But they had to call it an insurance score to get it passed through the legislators to allow the insurance industry to use credit scores to determine policies and premiums. And you should know that if you go from excellent credit to poor credit, you're paying close to double for the same amount of coverage for homeowners insurance or auto insurance. So those are big numbers. And when people ask me all the time, Paul, what does credit have to do with my auto insurance? What does credit have to do with my homeowner's insurance? Well, once the actuaries did their studies and surveys, and they were able to prove that a person with a lower credit score is more likely to have more tickets, to have more points on their license, to get into more accidents. And actually those accidents were for higher dollar amounts in insurance claims. And they were also able to prove that for homeowners insurance. Again, all other things being equal, somebody with a lower credit score is going to file more homeowners insurance claims, and the amount of those claims are going to be higher. So once they proved that, it was only a matter of time before the insurance industry was able to get those laws passed. So here we are. There's lots of times, unfortunately, in my day-to-day operations where I have to tell people, it is what it is. You know, we're stuck with this system, so we have to do the best we can in trying to manage it. So I'll go through some specific situations that we should know how to handle it, how to deal with it, how to talk about it. I often try and stress to realtors across the country that you can actually use credit as a marketing tool. And you should be able to kind of talk the talk as a real estate professional. I'm a certified FICO Pro. I spend my life trying to figure out this awful industry. But you don't have to be a certified FICO Pro. You don't have to be a credit expert per se to be able to talk about what's going on. And one of the best analogies or examples I use are inquiries. If there's one buzzword that I hear in every networking event, whether it's, you know, at a convention or out to dinner with my family and friends, people always talk about inquiries. And inquiries have gotten a terrible reputation and bad rap as of late. And a lot of that has to do with companies like Credit Karma. They spend a tremendous amount of money on marketing and advertising. We've all seen the commercial with the girl who's going to click the button to check her credit, and the guy's like, no, don't do that. The reality is this: inquiry can cause a drop in your credit scores. Might only be a couple of points, but a couple of points could be the difference in getting a different interest rate or getting approved for a different loan, type of loan or some type of program that's offered out there. Pinky will tell you that a 737 is not a 740. So if you lost 3 points because of a hard inquiry, then that becomes a problem.
So Paul, can I ask a question when you are talking about that?
Sure. And by the way, I would much rather, like Pinky had said about the videos, if you don't want to be on video, that's great. But I would much rather have a participation conversation rather than me just kind of speaking into that pin dot. So I welcome the questions. Go ahead, Pinky.
Awesome, great. So a question that I know that agents face a lot, right, is when they ask their clients to get pre-approvals, and you guys, back me up or speak otherwise if I'm speaking out of turn here, but questions that you hear often as a realtor when you tell a client to get pre-approved is that they don't want a hard inquiry on their credit. Am I right about that? Are you guys hearing that sometimes, right? So, and you, Paul, and the reason why they say that obviously is because they know and they've heard that an inquiry will drop their credit score.
Yep.
So I have a response to that, but I'd love to hear your response from your position. Like, how would you advise our agents here to answer that objection when they face it?
So if somebody gives that response, you have to let them know that it is critical that they get a credit report with real FICO scores within the mortgage industry. So clients oftentimes say that they got a report from Credit Karma or their credit card. They see their credit score every day when they log into their account online for their credit cards. And those are FICO scores, but those are consumer FICO scores. Oh, definitely. So what everybody has to realize is that a mortgage FICO score is different than an auto FICO score. And an auto FICO score is different than a consumer score. So if you want to know what you're going to get approved for, the only way to do that is allow the bank to pull your credit one time. There is a risk, a slight risk that the inquiry may lower your scores, but it is well worth the risk to get the information that's on those reports and to get those industry specific scores. I will also tell you that here's how it kind of works with inquiries. The magic number seems to be about 6. So if a person has more than 6 inquiries in a 12-month period, that is when the risk for the scores to come down increase. So 6 or more inquiries in a 12-month period increases the risk that there will be a drop in the credit scores from a hard inquiry. But when you're talking about credit card balances and you're talking about late payments and the other factors that could drop the scores, those are much greater risks to the FICO score than an inquiry.
That's a great response. Thank you. Yeah. Any other questions you guys have related to that? What the other thing I tell folks, Paul, when they ask about that, when they call in and say, is it going to be a hard inquiry? Is that I do remind them that the credit score is good for 4 months. So as long as they are going to buy a home within the next 4 months or planning to buy one soon, then it's likely not going to have much of an inquiry. And then they tell me, but my credit score is 800 and I don't want to ruin it, right? So I tell them that even if it does drop 5 points, we as a mortgage lender don't view a 795 or 800 or 830 any differently. It's all in one bucket and it's all excellent. And so you don't have to worry about that. It makes no material difference to them if their score drops a little bit, is what I remind them. And then I also tell them that look, they're like, well, what if I don't find a home in 4 months? Well, then we do pull it again in 4 months. But again, if you're at that number and those are the only 2 actions that you've had on your credit, the chances of it having any sort of noticeable impact on your credit score are pretty slim. Am I accurate in saying that, Paul?
100%, 100%. And we've gotten, again, so caught up in credit scores because of those consumer sites that ultimately make money. I don't care if they say that they're free. Credit Karma was acquired for about $1 billion. So they make money. But the reality is, again, that credit scores are an infinite marathon. And, it's a race that never ends. And they constantly change. They're changing basically every 30 days. Every time there's new information that's reported to the credit bureaus, there's a change in the credit scores. So people should be much more focused on the information, managing the information that's on those credit reports. That's always going to dictate the scores anyway. So don't get so caught up in the scores. If you lose a couple of points, you'll get them back, in a month or 2 anyway. So that's really what I talk about, when people talk about inquiries. But you should know that there is a difference between hard inquiries and soft inquiries. A soft inquiry does happen if you pull a report from annualcreditreport.com. This is an awesome thing for agents to understand. Right now, under the CARES Act and during the COVID pandemic, consumers can go to annualcreditreport.com and pull a report every week. Previously, I say BC, before COVID, we had access to those reports once every 12 months.
Oh, I didn't know.
Right now, under the CARES Act, you could pull a report from annualcreditreport.com. That's the FTC's website. Those are good reports, okay? I consider annualcreditreport.com an accredited credit reporting agency, like when Pinky pulls a report, okay? Those are not consumer reports. Those are real reports, right? With real FICO scores. They're not FACO scores. So the information is as good as it's going to be, and those are accurate scores. The only caveat with annualcreditreport.com is you will not get your scores for free. So again, I always just direct people, we want to know what the information on your reports look like. That's always going to drive the scores anyway. But it's a great place for any consumer to at least start the process, right? They can go to annualcreditreport.com. They take a look at the reports. If there's stuff on there that needs to be managed and handled, then they can start that process also. We were speaking, before the official start of today's meeting. Unfortunately, again, the CFPB, the Consumer Financial Protection Bureau, released a statement regarding the response times from the credit bureaus, the lenders, the creditors, the third-party collection companies, the third-party reporting companies. And they've all been given a very gray area in time is of the essence. And they've been given extensions in the response times. So if we start a dispute and investigation with the credit bureaus, again, BC before COVID, you were looking at like a 30 to 45 day turnaround time from the start of that dispute and investigation. Now it's at least 60 days. It was almost 90 days a couple of months ago. So it's getting better for sure, but there's definitely a delay in the time that it takes to have a status updated or changed, have information deleted from someone's credit report. So there's no overnight fixes here, and it's going to take some time. It's always taken time, but now, unfortunately, there is definitely an increased amount of time that it would take to have the information on someone's credit report changed or deleted. Pinky scheme.
I didn't realize it was delayed, Paul, so that's good to know.
Yeah.
Yeah,
and I'm sure you guys could still do rapid rescores.
We can, yeah.
So
yeah,
that's an incredible value add, and you might want to just touch base on that quickly, Pinky.
Sure, I can certainly do that. And then, one comment that Tez made is when we were talking about the annualcreditreport.com, she was mentioning, and since it has no scores, supplementing it with most of our banks now offer credit scores too.
That's
How
exactly.
accurate?
Yep.
I find that those tend to be a little bit more on when they tell me that my score is X and then I pull it, it tends to be on. Do you have any thoughts on it's usually in a closer range, much better than like a Credit Karma, which is completely off the,
That's
misleading.
right. And that's because they are real FICO scores,
Right.
albeit they're consumer scores. So things are weighted a little differently, but you're going to be, not only in the same ballpark, you're going to be very, very close, to the same score. So that's a great way to do it. Pull the reports from annualcreditreport.com to manage the information and continue to monitor your scores through your banks that are giving you the FICO score.
The only caveat I have to that from what I see is that the banks are just pulling from one bureau. It's usually Experian, Equifax, or TransUnion, right? So they're only pulling from one. In the mortgage world, we have to pull from all three, and we use the middle score of the three. So if for some reason, I pulled a report yesterday and it was like somebody was a 790 and then they had a 700 and a 7, it was like one was just way off. And if that happens to be the one that you see on your bank, then we're going to get a completely different result. So just kind of I always just remind people that it's only one bureau. We have to look at all three. So from that perspective, that's another point.
Hey, thanks.
Go ahead.
This test, so thank you for covering that. That's sort of how I describe it as well. This is not the score that the mortgage professionals look at because the risk factor, the algorithm is different, but it gives you an idea, right? However, while you're talking about the rescore, can you just kind of touch also on, you mentioned that, say, a 795 versus an 800 from a lending perspective or rate perspective is not a whole lot. Can you actually tell us sort of the brackets, if you will, of, for this product? If it's 739 versus 740, it does matter perhaps, but if it's 79 versus, 800, it won't. It would just be good for me to know. I would imagine there's, Yeah,
absolutely. Thanks for asking, Taz. Yeah. So they're in increments of 20, basically. So we tend to go, 620 to 640, or 639, I should say, 640 to 659, 660 to 679, 680 to 699, 700 to 719, 720 to 739, and then we have 740 plus is all the same. So after 740, everything is fair game and the same, but underneath that is where you see the differences. So I hope that helps. Yeah. And then the rescore, I can address that too, Paul, you mentioned. So from a rescore perspective, what happens is if you guys send somebody over and we're looking to get them pre-approved, right? The idea that we just talked about the annualcreditreport.com and complementing with the bank, that's a great strategy. So when we are having that initial consult meeting, if they tell us they're not looking to buy for another year, for example, and they're just trying to get ready to buy next summer, I'm probably not going to pull their credit, right? Because it doesn't make sense. There's no value in doing it right now. But I would direct them to something like what we just talked about. So and say, have a look. Let's make sure that your credit is in a good place. Now, if they tell me I really don't know what it is, I really want you to find out and get a sense, we've got to figure out, then we might look at it. But if we see something there, then we're referring them to Linda and Paul and saying, hey, you guys, you need to fix up your credit. Linda and Paul are the right resource. We think it's very important that they go to somebody who is reliable. Unfortunately, there are a lot of credit reporting, credit repair companies out there that are not always looking out for the client's best interests. I mean, I've known Linda and Paul for many years through different, networking events is how we first met, but so I know that they are, in our community, they're reputable, they're going to do what's in the best interest of the client. So that's super important. So instead of letting your client say, I'll go to somebody I found, like I always remind them how important it is to go to somebody who we can trust on this, because it's too easy for people to take advantage of our clients. So we don't want to see that happen. And so then we refer them to them if that needs to be. If not, we'll just let them keep working on it. And then if we're closer, right, if we've got somebody who says, we had somebody recently who had something that they didn't know they were on their father's credit card, and he was the one that was not making the payments. So we had to help him get that resolved. And we could identify, so Linda and Paul, we didn't send them to because it was very apparent that was what the thing is, and they just needed to get him off of that, right? So they took him off of it, and then we had to rescore it. So just taking him off doesn't change the score. We have to actually then send that proof into the credit reporting agency, and they're going to go and verify it with them, and then we're going to get a brand new score. So that's called a rapid rescore. Usually takes about a week these days, and we need paperwork to do that. And so that's a way we can help people, where it's a simple identifiable thing that they can do to get their score better, and that helps us be able to do it in a quick time fashion when we've got somebody who's ready to go now and we need to just make that adjustment. So thanks for Paul for mentioning that that's something we can do.
Awesome. Yep.
And I don't know if you can see the questions, but Tez asked another question. Can we talk about the advantage and disadvantage of being added as an authorized contact or user to a credit line?
Yeah, so there really is no disadvantage if it's being done correctly. Being an authorized user is definitely a way that you can help somebody that has what we call a thin credit profile. They don't have a long credit history behind them. Becoming an authorized user with somebody, I say it should be like a blood relation. The only problem with authorized users is when people are buying trade lines, buying somebody else's credit history. Unfortunately, it is effective and it will work. The problem is it's a felony offense. It's actually illegal for a consumer to buy somebody else's credit history and have it put on to their credit report. It is fraud, and it's not, a slap on the wrist. It is a felony offense. So there are companies that are out there and they get away with it. Unfortunately, with some loopholes in the laws, being able to actually sell seasoned trade lines and credit histories. But if you have a relative or a very, very close trusted friend that will allow you to become an authorized user, that is the way that it can be done and the way that it should be done. And it will help boost someone's credit. Now, with the new FICO scoring models, the authorized user accounts do not get weighted as heavily as if it were your own account, but it will certainly help.
So thank you for speaking to that. I actually came into this not from my industry, but my sister, my much younger sister, wanted to rent an apartment, and credit, she's young, right, was an issue. I was not willing to co-sign, but I had heard that I could do this, and I did. And her credit went up, ridiculous, like over 100 points in a matter of weeks, right? I then started to think about, wait a minute, I wonder if some of my clients can use it. So you're saying that it's okay to do, but yes, we don't want to make it like a business transaction, but if there is, real relations that people want to help each other out, that's okay to do, and it will help.
Exactly. So as long as they're not doing it, again, they're not purchasing someone else's credit. They're doing it just to establish and help themselves, then it's completely fine, and it will help boost the scores like you saw.
Yeah. Okay, thanks.
Yeah.
Any other questions regarding that? Okay. So what I also want to talk about, again, I did mention the new FICO scoring models. And again, this is a great talking point for real estate professionals. Every once in a while, FICO releases a new scoring model. Unfortunately or fortunately, they're very, banks are very reluctant to change. So most banks are still, in the mortgage industry, are still using the FICO 4 scoring model that was released in 2004. So there are the most widely used FICO scoring model is FICO 08. That is certainly the one that's used in the auto industry and credit cards. But most banks are still using FICO 04. So the new scoring models are called the FICO 10 and the FICO 10T. And the T actually stands for trended credit data. So the new scoring model, the FICO 10, is going to penalize consumers for a couple of things. They're going to weight late payments even more heavily than they already do. So in today's environment, a 30-day late payment, again, there's no way to tell exactly how many points someone's going to lose for a late payment because every single credit report is different. And depending upon the exact moment in time that that event, that 30-day late payment happens, will determine what scorecard, okay, and not to really blow your mind here, but let me explain to you how this works. Nobody really has a credit score right now. Credit scores are generated in real time when the reports are pulled. The scores are based in real time on the information that's presented to the FICO scoring model. So the information from the previous 24 months carries the most amount of weight towards today's score. Most of the information will stay on a credit report or can stay on a credit report for up to 7 years. Bankruptcies, Chapter 7 bankruptcy, will stay on for 10 years. But it's the information from the previous 24 months that carries the most amount of weight. And that is why the trended credit data is going to be useful for the banks. It might actually hurt a lot of consumers. So trended credit data will look at the previous 24 months historical data concerning the lines of credit, the accounts that are on your credit report. And the most important accounts are going to be credit cards. So right now, if somebody was going to be applying for a mortgage and they were carrying high credit card debt, their credit scores might be a 680, okay? Because their utilization ratio, that's the difference between your credit card balances and your credit limits. As soon as you go over 30% of your balance to credit limit ratio, your scores will start to come down. If you continue to go over that ratio, 40%, 50%, the scores are coming down, and they're coming down rapidly, and they will be a dramatic drop in the scores. If you go over your credit limit by $1, you could easily lose 50 points off your credit score. And I do want to talk about one thing specifically regarding maxing out credit cards and going over the credit limits. Pinky mentioned forbearances and deferment programs. Most banks and creditors offered some type of payment relief programs, and they were either forbearance or deferments. The problem that we're seeing is people that had their credit cards almost maxed out. Most of the minimum payment is going towards interest anyway. So let's say they were given the ability to skip 2 or 3 months of the payments on their credit cards. The interest will still accrue. And if the interest is not paid, a lot of times it was driving people over the credit limits. And again, that's going to drop the scores at that point in time. So just be careful if you have people that have entered into forbearance and deferment payments for their credit cards, that they have to look if the new interest that's going to get added, even during the deferment period, is going to drive the scores, drive the the balances over the credit limits. That's a bad thing for sure. So just pay attention to that. So the FICO 10T is going to look at the 24 months prior to today's credit report. It's also, again, it's going to penalize consumers for that utilization ratio that we just spoke about. It's going to be weighted that much more heavily. So the way it works is payment history is the #1 factor when you're talking about credit scores. Nobody knows the exact algorithm and formula that FICO uses. I always say it's a more closely guarded secret than the Coca-Cola recipe. But we do know what factors go in to the scoring model. And #1, by the way, is payment history. So if you pay your bills on time, you're going to have a better credit score than someone else who doesn't pay their bills on time. I mentioned a 30-day late payment. This is how the credit reporting industry works. A 30-day late payment will happen if you fail to make the payment 30 days after the due date. So it's not 31 days. It's not before the next payment. It's 30 days after the due date. So if we had a payment that was due today and I didn't make the payment, if I didn't make the payment for 2 weeks, that's not a 30-day late payment. It's not going to get reported to the credit bureaus. But if I failed to make that payment for 30 days after today's date, that gets reported to the credit bureaus. And a 30-day late payment, again, easily drops someone's credit score 30, 50, up to 100 points, depending upon what that individual's credit profile looks like.
And Paul, we should mention that the recency makes a factor too, right? So if someone has a impeccable credit history and the day before I pull credit, they had a late payment, what am I going to see?
Yeah. Again, you could easily see 50 points, a drop in the score, and that's going to wind up costing the consumer a tremendous amount of money. So Exactly. It's not, you know, when we talk to some clients, they say, you know, I think I have pretty good credit. You know, I've missed some payments here and there. I go, oh boy, you know, this is not going to be good. Payment history, obviously, and rightfully so, carries the most amount of weight. The second scoring factor, which is payment history is 35%. The utilization ratio or amounts owed is 30%. So as you can imagine, again, people who have balances on their credit cards that exceed 30% of the credit limits, it's going to have a tremendous negative impact on the credit scores. So if you paid your balances down below 30%, you will get a jump in your credit score. But that will not happen under the new FICO 10T scoring model, because they're going to look back over the 24-month period and do the average of the balances to credit limits at that point when they're generating the FICO score. So whether or not banks are going to adopt this new score more rapidly than they have in the past, that's yet to be seen. I will tell you that it is my professional opinion that banks are going to adopt this scoring model more quickly than they have in the past. FICO actually came out and said that they think they can help decrease a bank's default rate by up to 17%. So those are big numbers for banks, you know, for sure. So
Paul, I want to make sure I heard you right on that one. So you're saying the FICO 10T, right? The new one that's coming out that banks still have not adopted, but may adopt, right?
Yep.
That the credit utilization, because they're looking at a 24-month trend, if I had somebody who came in and had a high balance and I told them to go pay that off,
yes,
that may not have the same impact as it used to on the FICO 10T. It may still, because they're looking at the average trend for 24 months, that client's credit score may still remain low in that case. So we're going to have new tools and ways to help these folks improve their score then. Correct?
100%. That's right. Okay. So again, paying the credit card balances down is always a good thing. It will definitely help increase the score, but you will not see the same impact as you do under the current scoring model.
That's very interesting. So I guess we'll have to wait to see if it gets adopted, and then we'll, if yes, then we'll figure out the ways to deal with how to help them in that situation.
Yeah. So again, for real estate professionals, just knowing that FICO released a new scoring model is a good tip to put out there to your clients or prospective clients. Knowing that FICO has now also released, and we don't know what it's going to be used for in terms of lending yet, but it's called the resiliency score. So along with your FICO score, the FICO scoring model has now released what's called a resiliency score. And that is going to be a score that is, or supposedly, indicates your ability to withstand a economic downturn like we're seeing right now during the pandemic, like we saw back in 2006 during the housing crisis. So I think one of the good things about what we're going through now is that this was not a housing crisis. This was not even a market crash, a correction. This was a public health pandemic that has put tremendous strain on the markets for sure. But I actually believe that it's the housing market that's going to help lead the charge out of the pandemic and into the recovery. So as real estate professionals, we should be geared up for that. We see a tremendous amount of movement out of cities and urban areas into the suburbs and rural areas. So that's really great for us as real estate professionals. The third factor in the FICO scoring model is length of credit history. And this is definitely a misunderstood factor, score factor. Pinky said it before, and sometimes agents make the mistake. If they're working with somebody early on, they might say to a borrower, you're going to have to clean that credit up. You're going to have to fix your credit up. And sometimes what the consumer hears is, I'm going to go ahead and close these accounts that I don't really use. It's going to look better to the bank if I pay off this auto loan early. And it's the exact opposite will happen. Okay. So closing a credit card is typically the worst thing the average person can do to their credit, because it has a negative impact on two score factors: your credit history, which is what we're talking about right now. The length of your credit history is 15% of the overall score factors. So if you close a credit card that you've had open for a long time, you lose the credit history of that account immediately. You will also lose whatever available credit that you had on that credit card. So here's the perfect storm when you're talking about credit history, right? Client calls up Discover Card, and they've been a long time client. They've been with Discover Card for 15, 20 years, and they ask for a lower interest rate. Discover says it's not available at this time. So the client gets angry and closes that Discover Card that they've had for 15 years. Now, they were close to going over that 30% rule on the utilization ratio with the Discover Card in place that had a $20,000 credit limit. Now, closing that card actually had a negative impact not only on the credit history, but on the utilization ratio, because it now pushed that ratio over the 30% rule. So closing that one credit card just had a negative impact on 45% of the score factors that go into the FICO score. Now, take it a step further. I don't have to tell the agents that are in the meeting today the phenomenon that happens from here to California, all over this country, probably the world, but people get nuts when they put the contract in on a new home. We haven't closed anything yet, but you put the contract in, and the consumer goes out, the borrower goes out and purchases furniture. And while they're checking out, whether it's online or at the store, they see the ad pop up, or the person behind the counter says, do you have an Ashley Furniture credit card? Do you have a Raymore Flanagan? Do you have a credit card with it? No. Well, you'd save 20% if you open up that card today. Well, that new account, okay, is going to now, the length of that credit history is 1 day. So you just took an account that you had open for 15, 20 years and you closed it. And then you opened up a new account. So you just had a tremendous negative impact on your overall length of your credit history, the average length of your credit history. So don't just close any credit cards. Don't pay off loans early, especially during the window of purchasing or renting an apartment or applying for any type of financing, because the FICO scoring model is built on that monthly management of debt. And I might also add that we hear people all the time say, and this is a good thing from a financial planning standpoint, I don't have any credit cards. I pay cash or I use my debit card for anything. I haven't had a credit card in 10 years. I don't have my cars is bought and paid for. I don't owe anybody anything. But in the FICO world, that's actually not a good thing. You need to be able to demonstrate the ability to manage debt. And when you heard me talk about before that the system is flawed at best, the fact is that the FICO scoring model forces us to carry credit cards. As a matter of fact, the FICO scoring model rewards us for carrying a small balance on those credit cards. Believe it or not, all other things being equal, somebody who carries less than 10% balances on their credit cards will have a slightly higher credit score than someone who pays off those credit cards in full every month.
I did not know that.
What's that?
I said, I did not know that. That is news to me.
So it took me a long time. I did not swallow that pill easily. I fought it because it doesn't make any sense.
Yeah.
But when I became a certified FICO Pro, I had to go through classes and I had to take an exam and all that stuff. And I wrote email after email. I wanted further clarification. I needed to understand why that someone who carries a small balance, less than 10%, would actually have a higher credit score than someone who doesn't. But that's the truth. So when you spoke before, Pinky, about finding new ways and tools to help people, that's definitely a tip that we would give a client, especially if there's nothing else on the credit report that can change, but you needed, 10 points, 15 points, 5 points to get them a little bit better interest rate or get them a better program. That might be something that helps them.
Wow. Good shit.
Yeah, and the last two score factors are new credit is about 10%. So again, scores will come down anytime someone opens up a new line of credit. And it takes about 6 months to season that trade line. So the new account is scary to FICO because they don't know how you're going to manage the new account. After about 6 months of on-time payments, that new account may actually help the person increase their credit scores. Types of credit, you have revolving credit. Those are your credit cards and department store cards. And you have installment contracts. Installment contracts are those fixed monthly payments, like mortgages, student loans, auto financing. I always throw in a bit of forewarning here concerning revolving credit. There is a loan product out there that actually gets reported on a credit report like a credit card. Do any of the agents that are on today's meeting know what loan product, what type of loan gets reported like a credit card on a credit report?
Self-lender?
What's that?
Self-lender? What do you mean?
No.
What was the question again?
A home equity? Is it a home equity loan?
It is a home equity line of credit, a HELOC. They're very popular. It's a great thing for someone to utilize. A HELOC works like a credit card, right? You're gonna take out a certain amount of credit, and you're only gonna pay interest on the money that you borrow. And it's a very popular loan product for people that are doing a remodeling to their home. The problem, there's a couple of problems. A, most of the time, HELOCs go well over the 30% rule when it comes to balances to credit limits. People take out HELOCs. The typical example is this. They get an estimate to do the work on their home. It's going to be $100,000. They go to the bank. The banker talks the person into taking out a HELOC because it looks good, it sounds good. So they take out a home equity loan for $100,000. You're only going to borrow, you're only going to pay interest on what you borrow. Well, the estimate was for $100,000. So most of the time we go over budget anyway. And now that credit card or that home equity line of credit is maxed out. And that can have a tremendous negative impact on someone's credit score. If I were in that situation, and I tell people all the time, I am not a licensed loan officer. I am not a certified financial planner. But if I had my options, I would take out a home equity loan. I would take the entire loan at one point, put it into a money market fund, earn a couple of bucks on it because I have to pay interest on the entire balance. So be it. But what I will know is this, that it's not going to get reported on my credit report like a credit card. It's not a revolving account. It is a installment contract, which will actually help my credit in the long run. And the second thing is, during the pandemic, we saw a tremendous amount of lines of credit that were either frozen or significantly reduced. Okay, they took people, they had open lines of credit that they just had sitting there for a rainy day, ironically enough. They had a $100,000 line of credit in the bank for just waiting for the rainy day. The banks were cutting them in half. Now you only had access to 50,000, or they were freezing them. You couldn't even have access to those lines of credit. So just be careful when we're talking about home equity loans and home equity lines of credit. Are there any questions on that?
Not on that particularly, but I have questions about the payoff. Sometimes I hear that there's sort of a strategy to it. So it could be that 30% rule. So when we're talking about the entire person's portfolio, like they're going to need some funds for closing costs, for example, right? So I always hear, talk to someone before we start paying off stuff because A, you may need the funds for something else. B, it may not make the difference that you want. And then something about write-offs and collections, like what do we need to know about those?
That's a great question. So it goes back to what I said before also, when agents say something with good intention, but it doesn't always go as planned. So people say, hey, you're gonna have to take care of those collections. Now what that says to a borrower is I'm gonna have to pay them off. When in fact, what should be done when specifically regarding collections, third-party collections, is what's called a verification and validation of debt. Because believe it or not, paying off a collection, certainly a collection that is more than 2 years old, has a tendency to drop the credit scores in the short term. Ultimately, the only way a person is going to achieve their highest credit score possible for them is to not have unsatisfied collections. But in the short term, paying off a collection that is more than 2 years old, and even if it's not. So I just say the rule of thumb is don't pay off any collections at this point in time. There are lots of programs, and maybe Pinky, you can talk about it, that will allow the borrower not to pay off the collection. If they're under a certain amount of debt or what type of collection it is, it might be a situation where the collection can get paid at closing. But again, paying off a collection prior to closing can actually lower the credit scores for sure in the short term. So if it's something that needs to be satisfied, it should go through what's called a verification and validation of debt process. What we find is so often the third-party collection companies are violating the FDCPA, the Fair Debt Collection Practices Act. And if we find a violation under the FDCPA, the item gets deleted from the credit report immediately, the debt gets erased, and the client gets paid $1,000 directly from the third-party collection company. This is a great situation, again, not to pat ourselves on the back, But we actually offer that service, the VOD service, for free, because if we find violations under the FDCPA, our attorneys also get paid from that third-party collection company. So the client doesn't have to pay any money for the VOD process. The client may be entitled to $1,000 per violation. And the worst case scenario is that the debt comes back verifiable and it's a valid debt. And then it might be a situation where we would arrange to have that debt paid at closing rather than paying it off prior to, which can open up a can of worms and actually cause a lower score.
That's new. I didn't know that. Yeah.
So that was a great question.
Yeah, thank you. And thank you, Taz. So appreciate your active engagement here and asking questions. Thank you so much because we want to share what's relevant for everybody. And I'm hoping that those questions are helping others as well. So thank you for asking those.
I've always been that student where everyone wants to leave and the professor, I'm like, I have a question. And I was like, oh God, her.
Yeah,
well, for you, we're happy that you're asking.
The meeting's not over yet. We'll see how it goes. So I also want to touch base quickly when we talk about annualcreditreport.com. We talk about Pinky's the bank. They who do you guys pull from?
Kroll, factual data.
Yeah, I mean one of the best. They've certainly the pioneers in the industry. But the problem is that Kroll Factual is different than CIS, and CIS is different than Credit Plus, and Credit Plus is different than annualcreditreport.com. So all of those credit reports are laid out differently. If you go from one bank to the other bank, they might be using a different FICO scoring model. So the reality is that as a real estate professional, you just need to understand what's actually in the credit report. Each and every credit report, if you can identify these 5 areas, then you can be comfortable with the information that's on that report. And like Pinky had mentioned, there could be up to 100-point difference from TransUnion, Equifax, and Experian. And the reason, or the most common reason for that, is that not all creditors report to all 3 credit bureaus. And the reason for that is creditors actually have to pay for the privilege to report that data to the credit bureaus. So you have some smaller banks, credit unions are notorious for this, small lenders and third-party reporting companies. Sometimes they choose to only report to one bureau. It's that information, if it's negative, that can actually cause a pretty significant difference in the credit scores. So I always say make sure you're looking at a 3-bureau tri-merge credit report, and these are the areas that you should identify on each and every credit report. The first area is the identifying information: name, address, date of birth, social security number. But this information has to be 100% accurate. If the borrower uses a middle initial and it's not on the credit report, or they don't use a middle initial and the wrong middle initial is on that credit report, that could cause what's called a merged credit profile. They might have information from somebody else's credit history on their credit profile. Very, very common when it comes to juniors and seniors and the first and the seconds and the thirds, the Bob Smiths, the Jim Jones, the Robert Browns that are out there. So 230 million credit profiles that are out there. It is very common to have merged data on these credit reports. So you need to make sure the names are spelled 100% correctly, the address is 100% correct, the date of birth, social security number, everything's 100% correct. Also, this is an area where you would want to look for red flags of identity theft. And that's going to happen in the previous address section. So the identifying information, you want to look at everything that's on there. And you need to pay attention to previous addresses. One of the first things identity thieves will do is that they want an address on the credit report that's associated with your social security number. Because if and when they're successful in opening up a new account fraudulently, they don't want that information sent to your address. They want the information sent to the identity thief's address. So you're not alerted to the new account. So if there's a previous address or an address that's associated with that client's credit report that doesn't belong there, you have to be proactive at that point in time. You have to contact the bureaus and make sure that address is removed from the credit report. The account information, the most important thing for each and every account is what is the status of that account? Is it open? Is it closed? When was it opened? Are there any late payments? Is it being paid as agreed? Is it in collections? And we spoke about collections a little bit ago. So make sure you know the status of each and every account. There will be a section for inquiries. Inquiries will stay on the report for up to 2 years. It's the inquiries from the previous 12 months that are going to carry weight towards the FICO score today. And public records. There will always be a section for public records. You can't kind of just look at the report and say, I don't think I saw any public records, so there are no public records. Find the section that says public records, and it's either going to list the matters of public record, or it's going to say there are no public records. So it's just really important for you to identify all of those areas on the credit report. Sometimes there will be an actual separate section for collections, or sometimes you need to check the status of each and every account to find out if any of those accounts are in collections or they've been charged off. This is another great talking point to people for real estate professionals. A charge-off is a collection. A charge-off is a collection that is now being reported to the IRS. The company is making a statement to the IRS saying, we don't think we can collect on this debt anymore. But it doesn't mean that that company can't sell the debt to a third-party collection company. It doesn't mean that it can't ultimately become a judgment on someone's credit report. So again, a charge-off is nothing more than a collection with a different status and a statement being made to the IRS. Any questions on any of that stuff?
That's a good overview.
So when we talk about public records and we talk about judgments and we talk about tax liens, back in July of 2018, okay, now, 2 years ago, there was an awesome thing that happened for us as consumers, and it was called the National Consumer Assistance Plan. Most consumers know nothing about this. Most real estate professionals know nothing about this. But NCAP was put forth by the FTC and the CFPB when they really started again looking at the credit bureaus and figuring out how on earth can they operate with such a great margin of error. So they asked the bureaus to look at their own data and identify the items that are most often misreported. And they came up with 2 items that are most often misreported: judgments and tax liens. And think about that. Those are big ticket items. Experian, when they analyzed their own data, they came out and said that 96% of judgments and tax liens would not meet the criteria of the new reporting formula to make those verifiable and validated. 96%. So the bureau said, well, we're setting ourselves up here for a class action lawsuit. So we're going to agree under NCAP, the National Consumer Assistance Plan, we're going to agree under NCAP not to report civil judgments and tax liens. So if you look at a credit report today that has a civil judgment or a tax lien on there, they do not belong there. This is also another free service that Better Qualified offers, because it's not hard, right? It's really easy to have the judgments and the tax liens deleted from someone's credit report relatively quickly, because under NCAP, they don't belong there.
So
Any
Paul, if I
questions?
understand correct, you're saying that what you guys do at Better Qualified is you will remove people's judgments at no expense. Is that what did I hear that right?
Yeah.
Wow,
If
you
they
guys, I don't know if you heard that. That's pretty amazing that you guys are offering that. Yeah.
Yeah, if they have a civil judgment or a tax lien, it's something that we offer. And always remember this, like, we're 100% referral based within the real estate industry. So we always like to do certain things like that type of service and truly be a resource to our partners. So as an agent, if you talk to someone or you know someone that looked at a report, they, I have this judgment on my credit report. Your spidey senses should go up and say, wait a second, I know someone that can help you in that situation.
That is
Also,
great. Well, thank you.
Pinky, you mentioned it and you said it best in the beginning. Unfortunately, there still are a lot of companies that are not reputable. They're not ethical. Some of them are outright scams that operate under the credit repair, name. So if you would like to find a reputable company, okay, obviously we'd love for you to consider Better Qualified, but there is a website and a group out there called the National Consumer Assistance Plan. NACSO, the National Association of Credit Services Organizations. NACSO, National Association of Credit Services Organizations. That's actually a group that I was part of forming not so long ago. We've been down to Washington, D.C. I spoke on Capitol Hill at a government affairs conference concerning the credit reporting industry. But this was a group of credit repair organizations that got together, because the problem is this: credit repair organizations are unregulated in the United States. We're not regulated at all. So, so we got together and we said, this is not a good thing for us, for the companies that are trying to do the right thing. So let's regulate ourselves. So the companies that belong to NACSO have to go through a vetting process. A company has to turn in all of their marketing material. A company has to provide their contracts, everything if there's any scripts involved with their salespeople. So we look at everything and then we say yay or nay. So if you need a reputable credit repair organization, you can go to NACSO, pick any one of them, and you would be comfortable with knowing that they're going to do the right thing. So I always like to throw that out there.
Yeah, thank you. That's good to know. And I guess in general, like if we, wrapping up here, right? I would like to also let you guys know that if you guys have renters, right, and you're trying to get them qualified, if I know you don't do a ton of rental business, most of you, but if you are doing it, or agents that are, and their credit is not good, then you guys can certainly refer them over to Linda and Paul, and they can help get them to get it to a better score so they can rent. So that's certainly another option. Obviously, if they're buying, you would probably send them to us. We'll figure out if they don't have a great credit score, and then we'd send them over. But we definitely, just because they're not ready now doesn't mean they're not going to be ready, whether it be to rent or buy. And there are resources to help these clients get into a position, because everyone does deserve a right to own a home. And if they're willing to put the effort in, we are willing to do the same and get them to a place of qualifying.
Yep. And you might have a client who's having trouble even getting into the unit, the rental unit. Certainly we deal with a lot of folks, in the 5 boroughs in New York. It's harder to rent or lease an apartment than it is to buy in a lot of situations.
In New York, it's insane.
Yeah, a lot of property managers will not go below a 700. So we actually have a member letter or landlord tenant letter that identifies the client is currently actively working at building, managing, and monitoring their credit through our program. And based upon what we're looking at, I always sign and stamp the letter as a certified FICO Pro that it is my opinion that the person is a qualified tenant, because there's areas on the credit report that we feel are going to be deleted. And we have helped people actually get into the rental unit, even though they're under the property manager's credit score requirements.
Yeah, awesome. Thank you. Thank you. Fantastic. Well, thank you. Oh, does DTI include rent or only revolving? Or it does include rent if they're going to continue to rent, Tez, if they're not, you know, if they're buying like an investment property or a second home. But if it's a primary resident, then we don't include rent in it, because that means they'll no longer be paying the rent. So to answer that question. So thank you. Thank you. This has been extremely helpful. You guys, I will send out, I know that, Paul, we were speaking before and you said you have like a Corona and credit survival guide or something that you can share with folks, right?
Yep.
So
Yep.
I will share that with everybody that was on the call here, and I'll include contact information for Linda and Paul, so you guys have that also. If you have any questions, feel free. Is it okay if they reach out to you directly too?
Yeah, sure. And I can actually, let me see if I can pull this up here. I don't know, Linda, if you want to give people the text, I might even have it. I could share my screen.
And while you're looking for that, Paul, you guys gave such great information. I had a set of questions clearly, and it was a lot of good information. But how do you, this is a business, and so you get compensated somehow. How does that work? What can our clients expect from that perspective?
That's a great question. So the consultation and credit analysis is always free. The worst case scenario, the client walks away with a tremendous amount of knowledge. What they can do to try and help themselves if they don't wish to hire us. But if they choose to hire us, we have a 6-month membership program. The client pays us on a monthly basis. By law, we can't get paid in full up front. Our average file right now is coming in at around $900. So typically that would look like a $200 to $300 membership fee, and then they will pay a monthly subscription for the next 6 or 7 months.
Got it. Okay, thanks.
Yeah, awesome. Fantastic. Well, thank you for sharing with us this morning, and your the knowledge and what you've imparted on us has been truly helpful. And Linda shared the card that she has, and I think you have do's and don'ts on there as well, Linda, correct? On that card? Okay, so if you guys want to text Bosch to 40691, Linda can share with you not just her card, her business card, but it also has some great do's and don'ts on there for you to be able to have access to for your clients. So definitely take advantage of that resource also. So thank you all. Tez, again, thank you so much. Special thank you to you for your active engagement and questions, because that was really helpful for us to be able to have that and respond to. So thank you, and thank you everybody for joining, and Paul and Linda for being here with us and sharing everything. So
Thank you, Pinky.
Yes, thank you.
Stay safe, everyone.
Thank you. Bye-bye.
Thank you. Very helpful. Thank you.
Thank you. Bye-bye, everyone.
Have a good day.
You too. Thank you.